Here with us here on Business Today, I'm Madhabi Puri Buch. Here are the day's top stories. Weak global cues and recessionary fears continue to spook markets. Nifty and Sensex bear losses to close flat, climbing to the highest point of the day. The recovery aided by IT and metals. Proposal to extend trading hours from 9 a.m. to 5 p.m. gains traction. Move comes as the regulator aims to move towards regular liquidity operations. NSE Chief Ashish Chauhan backs the proposal, says 6 hours are not good enough for a market like India. India's largest car maker, Maruti Suzuki, announces the launch of 2 SUVs at next month's Auto Expo. Company chief RC Bhargava alludes to lack of infrastructure for company's delayed EV foray. Market regulator SEBI announces changes to buyback norms. SEBI chief Madhabi Puri Buch says they intend to phase out buybacks via exchanges gradually. The minimum utilization amount for buybacks via exchanges now raised to 75% versus 50% earlier. Google announces a whole host of features on its video streaming platform YouTube. New expected features to include a search in video option, also monetization of short videos. On to the latest from the buyback space, where market regulator SEBI has tweaked buyback norms. Chief Madhabi Puri Buch emphasizes on the need to phase out buybacks via stock exchanges, says the tender route is more equitable and other routes are all vulnerable to favoritism. Listen in.
We feel that the tender route is the more equitable route to buyback, and that the other routes are vulnerable to favoritism, let me say, because nobody really knows that in the exchange mechanism, when is the company going to come in order to buy back the shares, and only a few people may be aware of it and benefits may flow to those few people. It is not an equitable mechanism, and in that context we are therefore seeking to phase out the stock exchange route for buyback. But in the interim, since we don't want to have any knee-jerk reaction to anything and we have given a glide path, in the interim, we propose that there will be that minimum utilization of the earmarked amount should be increased from 50% to 75%, which means that if you announce a buyback, you must at least do 75% buyback. And also that there will be a separate window on the stock exchange. It cannot be nebulous and it matches with just anybody. There is a separate window for buyback, and that will also assist going forward in terms of identifying the tax-related issues which are important in the whole buyback mechanism. The tender offer route we are trying to optimize by reducing the timeline, and you will notice that one of the things that we have done, in SEBI, we've spoken about ease of doing business, of business process re-engineering, and you would have noticed on page 4 that we are completely removing the requirement of filing a draft letter of offer with SEBI and awaiting our observations. It's just eliminated. So we believe that this is a already listed entity. It has ongoing disclosure requirements. They are making public their intentions, and there is no need for SEBI to have any additional requirements or to make any additional observations, and people are expected to comply with the laws of the land. So removing altogether the requirement of filing and observations, which saves time, and also cutting short the tendering period and the period requirement for payment. We have now all digital payment mechanisms, so there's no reason for it to take so long. We are also permitting upward revision of the buyback price right up till 1 day prior to the record date.
Benchmark staged a recovery in the final hour of trade today. Sensex bouncing nearly 600 points off the day's low to finish with cuts of 100 points. The Nifty ending flat. What are the sectors that dictated the moves today? Market breadth was largely in favor of declines, led by realty and auto stocks. Surprisingly, IT and metals charged up the recovery in the final minutes of trade. The top laggards, SBI Life, Eicher Motors, UPL, Tata Motors and HUL. Cuts of about 2% and more on some of these names. Only a handful of gainers in today's session. Adani Enterprises, TCS, Big Boy Reliance, followed by some mild gains seen on Axis Bank. Concerns around recession continue to spook equities around the world. As Indian equities digest weak cues from its US and Asian peers, we ask whether it's time for investors to start tapping into profits from the rear and losing end of the markets. How must one tread amid this volatility? My colleague Sakshi Batra caught up with Centrum Broking's Nilesh Jain to get his views on the same.
What do you make of this sharp cut? We do know that most of these cues have actually come from across the globe. We saw the Wall Street slipping for the fourth straight session. We saw the Asian markets crash, and of course part of it has to do with the Bank of Japan move on the yield as well. Your thoughts on the kind of crash that we've seen, about 500 odd points on the Sensex today, and can this go deeper than this?
Very good afternoon to you, Sakshi. Well, you have rightly mentioned these cues are coming from the global markets. Internally in Indian equities, I don't see any major worries that so far. Numbers were on a positive side as far as quarterly numbers were concerned. And looking at the global market, where Dow has corrected for the fourth straight session, and that is basically is causing the worry. Now, looking at the overall structure of the Nifty index, which is moving towards the levels of its 50-day moving average, which is placed at 18,100. And our markets so far have shown resilience. If we look at the 2022 so far, we have outperformed the global market. Now, today as well, we are witnessing a small recovery from the lower levels that basically indicates there may not be a major correction going forward, and 18,100 could provide some sort of a support on the lower side. Any correction could be a good opportunity to make a fresh entry on the long side. On the higher side, 18,500 is the 21-day moving average resistance and also a psychological barrier for the Nifty. So overall, we expect the Nifty to oscillate in the range of 18,000 to 18,500, whereas Bank Nifty, although we are witnessing relative outperformance and 40,000 is a psychological support for the Bank Nifty, we expect a pullback in the banking space as well towards 43,300 to 43,500. Lastly, volatility index spiked 5.5%. That basically one should keep on radar. If it breaches 16 level on a higher side, probably that may trigger further sell-off going forward. So watch out for IVs. Currently, it looks very much in the comfort zone for the bulls.
But you know what, I'm looking at the Sensex, and from the highs that we've seen 3 weeks ago, the Sensex is down by about 2,400 points. Now, it's a sharp, downward move that we've already seen. But would you say down 2,400 points, is this a time to look at some bottom fishing for the investors, or can more pain be there in the offing and one should be absolutely cautious at this point? What is your suggestion to the investors?
Well, Sakshi, we started with the point that this fall is basically led by the global market, and our internals are basically looking very strong. And looking at the recent the correction that we have seen is kind of a healthy correction that we have already witnessed, and we are moving towards the support zones. And from here, I would advise to go stock specific and sector specific long position. Whereas if you look at on the sectorial front, Nifty IT index, where major correction seems to be over, there may be another round of sell-off that cannot be ruled out. But I think it's a good opportunity to make a fresh entry on the long side and add in the portfolio. And apart from that, Nifty Auto Index, we have already witnessed a good correction over there as well. Financials, I think that's the particular space which is likely to outperform going forward in 2023. And at current level, I think it's a good opportunity to make a fresh entry, a staggered manner. It should be bought in a staggered manner. And Sensex, I think it's a good entry level at current level.
Well, more important news now. The proposal to extend trading hours in India is gaining momentum as we come past the pandemic. If the said proposal comes into play, what does it mean for the investor community? How will this impact the exchanges? Earlier today, I spoke to Profit Mart Securities' Avinash Gorakhsakkar to get his views on the pending move and change the timings of the exchange. Listen in.
Typically, when you increase the timings for the market, that would obviously put a lot of short-term pressure on the broking community. Possibly there could be two set of people who work in different two time zones. So my sense is, yes, it's a welcome move. I think, if at all the trading time is increased, that would obviously help the exchanges. But I don't think it's going to help, either the retail or the institutional investors. Typically, I think this is a kind of request largely from the exchange community. So it's better to wait and watch rather than assuming that these things would happen, because this would obviously require a lot of requisite approvals before this thing actually gets cracking on the reality side. So I would believe that it's better to wait and watch rather than making any assumptions at this point of time.
Okay, fair enough. I mean, as you said, it puts a lot of pressure on the broking community and it hasn't really in the past shown any significant uptick in volumes. But, he has alluded to a few things. He has said that, for example, let me just read this out for you, that the move will help financials and mutual funds hedge and inject liquidity. Do you see that happening?
Yeah, I think as far as the timings of the market are concerned, as everyone is aware, the GIFT City, which is being started in Ahmedabad, is a 24/7 exchange, and I think that would definitely cater to the needs of international investors and the mutual funds. So I think my sense is that that would be a much bigger platform rather than increasing the timings for the exchanges here. So typically, I think it's better to wait and watch. But I think the GIFT City has definitely initiated that kind of move. So the Indian markets could get integrated with the international exchanges, and that I think would obviously serve its purpose. So net, I think it's better to wait and watch. I think because the GIFT City is definitely a better and a bigger platform, which actually takes care of the trading timings across the globe.
All right, fair enough. That's really the sort of consensus brewing there. And maybe that is the larger plan, isn't it, Avinash, to make sure that the markets are more intrinsically linked to what's happening globally. Would you agree? Because some pushback from Asia saying that this doesn't really suit them in terms of the way that they kind of balance out the trades post-closing. It won't suit them and it'll actually create further disruption.
Yeah, I think it obviously won't suit the Asian markets immediately. But I think there are a lot of global investors who have their markets open when Indian markets typically close. In the evening the US market starts. After that the Japanese markets open. So I think probably we require a global platform, which I think the GIFT City is going to initiate. So that would be a better opportunity. I mean, here, even if the trading timing is increased, my sense is it's not going to result in a significant increase in trading volume. So I think net, trading volume and the increase in trade timings, there has got to be a cost, efficiency. I mean, the cost to, time reward ratio should be matching for brokers, because obviously brokers are going to incur a lot of expense if they do have to increase trading timings, and that would obviously put some pressure on the smaller brokers. In fact, the institutional brokers would like it, but typically the retail and the HNI kind of brokers would not like it, because for them it hardly makes any difference.
We take a very quick break. When we return, India's largest car maker Maruti announces the launch of its new SUVs. Details coming up. Welcome back. Maruti Suzuki is taking the SUV drive to recapturing market share. India's largest automobile company is looking at launching 2 new SUVs and a concept electric vehicle at the Auto Expo next month. According to reports, Maruti could drive the 5-door Jimny into India, as well as launch a crossover based on the Baleno hatchback. Importantly, Maruti, which still has not entered the EV market in India, is looking at showcasing an electric car, which may be brought to the market in the next couple of years. So why has Maruti stayed away from the red-hot EV market? Is it too comfortably placed as the #1 player in the petrol and CNG market? The India Today group caught up with the chairman of the company, RC Bhargava, at the Indo-Japan conclave in Delhi. Here are the 4 big reasons as explained by him.
Where are the hiccups when it comes to electric vehicles? What are the areas of caution that you would like to address before you get in a full-fledged into that?
See, electric vehicles today in India have many issues. Firstly, we have had some instances relating to safety. Okay, but assuming we can get that out of the way. Now, the only people today who are buying electric cars are people who have dedicated parking slots because they can charge the vehicle there. And I think it's entirely reasonable that if you don't have a place to park the car and charge it, you are not going to buy an electric car. So that itself reduces the market. The second issue relates to the infrastructure available. I'm not even talking of the public charges, I'm talking of domestic charges in terms of the ability of the state electricity boards to upgrade the distribution system, including the transmission distribution lines and the transformers, to take the much higher load which will come when more and more people take electric cars. The range and public infrastructure, let's leave that out. I'm just talking immediately of even, let's say, today 1% of the sales are electric cars. Let us say this 1% goes up to 10% or 15%. The number of cars sold will be substantial, especially in the more affluent localities where people have charging points and houses to live in. What will happen to the distribution system? Thirdly, of course, is from the point of view of the reduction in the carbon footprint. We are, as it is, generating 75% of our energy from coal. So if you really look at the emission of carbon from the well to wheel, as they say, it's not a particularly clean transition, because if you have coal-fired electricity and then use it in electric car, then you're not doing very much to clean the atmosphere. So my belief is that in India, we need a mixture of not only electric vehicles, which some people will use, but we need to develop all the other CO2 negative or neutral fuels, like ethanol, like biogas, and even use hybrid technology to reduce the oil consumption, reduce carbon. All of them are required at this point of time, because electric vehicles are not going to become 50 or 60%. Keep in mind also the question of cost associated with the global changes in the price of lithium and therefore of batteries as the demand for lithium goes up. As it is with the global penetration of electric cars being 3% at present, lithium prices in the last year and a half have increased about 3 or 4 times. Now, if penetration becomes 30%, you see what will happen.
There's big news for social media content creators, with Google announcing that it will soon allow monetization on YouTube Shorts. Not only this, YouTube will soon enable searches in its videos. Listen in to what Ajay Vidyasagar, director at YouTube, had to say to Akanksha Chaturvedi.
So Shorts is a very special story for us. YouTube Shorts launched in India first, globally. And it's evidence about the importance of India and the sort of inspiration Indian users are giving us as a platform. What we do for India helps shape the work we do for lots of the other parts of the world. Shorts was a very telling example of that. We celebrated 2 years of YouTube Shorts in India recently, and what we're beginning to see is that Shorts has enabled creation to happen in scale. We are seeing creators from every nook and cranny of the country across multiple vectors of content, different verticals of content, different forms of storytelling, come in and participate and succeed in scale. The other vector of what Shorts has done for us is this is happening in multiple Indian languages. So if you think about the journey of YouTube, we were really 10 years back, we were a very metro phenomena. And that journey had started percolating into Hindi heartland and regional India. Shorts has taken that 10x further in, and the number of creators who are succeeding from the heartlands of India, from the heartlands of regional India, is extraordinary, and I would say that Shorts is a very big part of that catalytic positive impact. Now, for the first 2 years when we launched Shorts, we really didn't have monetization enabled in it. The way we helped these creators find value was the Shorts Fund that we had announced. Come first quarter of next year, we are announcing monetization within the YouTube Partner Program that allows for organic monetization to kick in for our creators. And so when I talked about economic impact, till now it's been really based on long-form creators and mid-form creators. What now we are going to enable is monetization for short-form creators.
Avatar, The Way of Water, has ended the drought in theatres. The film has made a massive splash at the box office, earning more than 160 crore rupees over the weekend. Film analysts predict it could be one of the largest grossers in the country.
Years after he took on the might of Colonel Quaritch and the Sky People, Jake Sully is back, and so is his Navi wife Neytiri. Both once again saving their exotically beautiful world from the evil military-industrial complex.
I see you. The way of water connects all things.
The premise has been lapped up by audiences worldwide, and the proof of the pudding is in the numbers. According to studio estimates, the Avatar sequel has earned 3,600 crore rupees worldwide since its release on the 16th of December. In India, the film has had the second best opening for any Hollywood film, mopping up more than 160 crore rupees at the box office. The best opening for any Hollywood film till now has been for Avengers Endgame, which earned 53 crore rupees on the first day of release in India. Avatar, The Way of Water has earned 41 crores. It's followed by Spider-Man, Avengers, Infinity War and Doctor Strange, making the latest release the only non-Marvel film in the top 5. Avatar has not only outshone the rest of the Bollywood films that released this year, it beat the record of Hollywood releases too.
You have to ride. Let's do it.
Even Bollywood hits such as Drishyam 2 and Bhool Bhulaiya 2 fail to get such numbers at the box office. The film is a boon for theatres and distributors thirsting for a hit at the end of 2022. The film was released in India in 4,202 theatres on over 12,000 screens. A large number of the screens were IMAX 3D. Avatar had a budget of around $350 million, making it one of the most expensive films ever, and with a runtime of 3 hours and 12 minutes, had its own set of skeptics who doubted its success. The high ticket prices also contributed to apprehension. However, the studio Disney and the director James Cameron were already confident of its success to the extent that a Part 3 has already been filmed and is set for release in December 2024. Another 2 parts are also on the drawing board. Bureau Report, Business Today TV.
That's where we leave it on the show tonight. Thanks so much for watching.